The program introduces modern portfolio theory, MPT, developed primarily by Harry Markowitz in the 1950s. MPT provides a quantitative framework for constructing portfolios that maximize expected return for a given level of risk. The theory assumes that investors are rational, risk-averse, and focused on maximizing utility through efficient diversification. According to the program, portfolio risk depends not only on the risk of individual assets but also on the correlation among asset returns. Combining assets with imperfect correlations reduces overall portfolio volatility through diversification benefits. This concept became foundational in modern investment management because it demonstrates how risk can be managed systematically without necessarily sacrificing expected returns. A key concept within modern portfolio theory is the efficient frontier, which represents the set of portfolios offering the highest expected return for each level of risk. Portfolios below the frontier are considered inefficient because investors could achieve higher returns without increasing risk. The program explains that rational investors select portfolios on the efficient frontier according to their individual risk preferences. Diversification plays a critical role because portfolio variance depends heavily on asset correlations rather than simply the weighted average of individual asset risks. When correlations are less than 1, portfolio volatility decreases. This principle explains why combining different asset classes, industries, or geographic exposures can significantly improve risk-adjusted performance within investment portfolios. The program also examines the capital market line, CML, which extends modern portfolio theory by incorporating a risk-free asset into portfolio construction. The CML illustrates combinations of the risk-free asset and the optimal risky portfolio, often called the market portfolio. Investors can adjust their exposure along the line depending on their tolerance for risk. Conservative investors allocate more funds to the risk-free asset, while aggressive investors may borrow at the risk-free rate to increase exposure to the market portfolio. The slope of the CML reflects the Sharpe ratio, which measures excess return per unit of total risk. According to the program, the CML demonstrates the trade-off between expected return and systematic portfolio risk. Topic also focuses on the derivation and application of the capital asset pricing model, CAPM, one of the most influential asset pricing models in finance. CAPM explains the relationship between systematic risk and expected return for individual securities. The model assumes efficient markets, rational investors, homogeneous expectations, and unrestricted borrowing or lending at the risk-free rate. CAPM concludes that investors are compensated only for systematic risk because unsystematic risk can be eliminated through diversification. The model introduces beta as a measure of systematic risk relative to the overall market. Securities with higher betas are expected to generate higher returns because they are more sensitive to market movements and economic conditions. The security market line, SML, is another major concept associated with CAPM. Unlike the capital market line, which evaluates efficient portfolios, the SML applies to individual securities and plots expected return against beta. According to CAPM, the expected return on an asset equals the risk-free rate plus a risk premium based on the asset's beta and the market risk premium. Securities plotted above the SML may be undervalued because they offer higher returns relative to their risk, while securities below the line may be overvalued. The program emphasizes that CAPM remains widely used for estimating cost of equity, evaluating investment opportunities, and assessing portfolio performance despite criticism regarding its simplifying assumptions. Topic also introduces several performance evaluation measures used to assess investment returns relative to risk exposure. The Sharpe ratio measures excess return per unit of total portfolio risk, using standard deviation as the risk metric. It is particularly useful for evaluating diversified portfolios. The Trainer ratio instead measures excess return per unit of systematic risk, using beta rather than total volatility. Jensen's alpha evaluates whether a portfolio generates returns above or below those predicted by CAPM. Positive alpha indicates superior risk-adjusted performance, while negative alpha suggests underperformance. The program highlights that these measures help investors compare portfolio managers and determine whether returns justify the risks undertaken. The program also examines the information ratio and the Sortino ratio as additional performance evaluation tools. The information ratio measures active return relative to tracking error and is widely used for assessing actively managed portfolios against benchmark indices. A higher information ratio indicates greater consistency in generating excess returns. The Sortino ratio refines the Sharpe ratio by focusing only on downside volatility rather than total volatility. This distinction is important because investors are generally more concerned about negative deviations from expected returns than positive surprises. The program emphasizes that different performance measures are appropriate under different investment strategies, portfolio structures, and risk management objectives, requiring analysts to understand the strengths and limitations of each metric. Overall, topics establish the theoretical foundation for portfolio construction, asset pricing, and investment performance evaluation within modern finance. Modern portfolio theory demonstrates the benefits of diversification and efficient asset allocation, while CAPM explains how systematic risk influences expected returns. Performance evaluation measures then provide tools for assessing whether investment outcomes adequately compensate for risk exposure. Together, these frameworks form a central part of risk management and investment decision-making across financial institutions. The program stresses that while these models involve simplifying assumptions and practical limitations, they remain essential analytical tools for portfolio managers, risk analysts, regulators, and financial professionals operating in increasingly complex global markets.